So today we're looking at the last few locations within our Tasmania series. So that's Devonport, Burnie and Ulverstone. And we're going to analyse all the usual metrics and work out whether they are good places to invest. So first up, we're looking at Devonport and the postcode of 7310, which also has East Devonport, Meandetta, Stony Rise, and numerous smaller towns. So looking at the overall employment industries within Devonport, very typical. Healthcare and social assistance is number one, followed by retail trade, construction, and education and training. Looking at the public housing data from OpenStats, there's quite a few significant pockets of public housing, as you can see. Some of them have tenure of 60% public housing within those areas, so obviously don't buy within those areas. I guess if you had to buy, you'd probably be looking at some of these yellow and green areas, and you'd be looking for a high owner-occupier percentage. So the owner-occupier percentage through the area kind of varied. Some pockets were as high as 70%, some pockets were as low as 30%. And although this data comes from OpenStats, it's actually derived from the 2021 census data. So we're now in 2025. These percentages may have changed, but it's probably the best data source that we have. From a town planning risk perspective, pretty clear for the most part, just some bushfire management overlays around the outskirts of town and some coastal inundation overlays. So quite a safe location from a town planning perspective. Looking at the asking price for a 3-bedroom house, currently sitting around $550. And you can see property prices within Devonport have kind of done about a 2.5x from 2018. So they were sitting around 250 grand. And we had a really big run up in prices until today at 550. So interestingly, we've seen some price growth since about 2023, and it looks like it's still sort of trending up. Looking at the vacancy rate of this postcode, it's been very tight since about 2018, so that probably explains this big run up in prices. When you have tight vacancy rates, you get rental growth, yields become more attractive, and then that spurs on capital growth. There's also interest rate considerations there in the mix. The current vacancy rate for this postcode is probably about 0.4%, which is incredibly tight. Speaking with a friend from Tasmania, the construction costs within Tasmania as a whole, and especially these regional locations, come at a premium to, construction costs in Melbourne, Sydney, Brisbane. It's hard to get trades down there, and the construction timelines are quite long as well. So it's very obvious that when you get population growth in Tasmania, the housing supply can't keep up with the demand, and that's why we're seeing this incredibly tight vacancy rate. And this narrative is really shown through asking rents as well. From about 2018 when that vacancy rate got tight, rents just ran up. And just looking at the stock on market at the moment, it's sort of tightened up to around 2022 and then came off a bit, but has been relatively stable. And the days on market for the suburb of Devonport is currently sitting at 57 days. So that's not a particularly hot market at the moment. But it is a bit strange that we have 57 days as the median time on market. And at the same time, we've been seeing a run up in the weekly asking prices of properties. It doesn't make a whole lot of sense to me. Moving on, looking at gross yields within the area, they're sitting at 4.7%. which is a bit tighter than what I would have expected for a regional Tasmanian town. I probably would have expected yields of sort of 5.5% plus. But if you're purchasing that median 3-bedroom house for $540,000, getting that gross yield of 4.7%, you're running a negative cash flow of about $8,900 per annum before negative gearing. And then just looking at the median income to median house price ratio, it's sitting at 7.7, which is on the higher end of affordability ratios. Just looking at some of the regional Victorian suburbs that we've been looking at, like Mildura, they're running sort of affordability ratios in the 5s and 6s. But at the end of the day, this affordability metric is just one metric in a wider set of data. I would just say that the really tight vacancy rates are attractive from a property investment perspective. The rising rents are attractive from a property investment perspective. But it's a little bit concerning that over the past 5 years, the price of a house within this area has basically doubled. Yeah, so this postcode is just really interesting to me. Just tighter yields than I would have expected. So now we're having a look at the Burnie area and this postcode of 7320. So it includes a fair amount of other suburbs. Rather than me reading them out and mispronouncing half of them, I've put them here for you to read through. From a public housing perspective, there were really just two pockets of significant public housing. This area of Shorewell Park down to the south, and this area had around 25% public housing just south of Emu Heights. The owner-occupier percentages in the area seemed okay, around about 60% on the whole. From a town planning perspective, there are a few sort of flood and inundation overlay areas and some bushfire management overlays around the city. Looking at the asking price for a median 3-bedroom house, it's currently sitting around $450,000. And again, since about 2018, the house price has doubled within this Burnie area. It's still trending up, but it doesn't look to be trending up at a big trajectory. Looking at the vacancy rates within Burnie, very similar to that Devonport area, quite tight since about 2018, currently sitting around 0.4%. And you can see that rents have been trending up in the area as well. The stock on market's fairly typical, tightened up around that COVID era and has kind of come off, but looks to be trending down. And the median days on market is currently sitting at 63 days for the suburb of Burnie, according to realestate.com. And looking at the gross yield within Burnie, it's sitting at 5.2%. So that's quite attractive, a bit more attractive than Devonport. So if you're purchasing that median 3-bedroom house for $450,000, getting a 5.2% gross yield, you're likely running a cash flow of around negative $5,600 per annum. And the affordability ratio is sitting at 6.5. So it looks to be a bit more of an attractive market from a yield and affordability perspective than Devonport. Moving on, we're looking at this Ulverstone area. It's got the postcode of 7315. It includes Ulverstone, West Ulverstone, and a lot of small regional towns. There's quite a large area of public housing up to the northwest in this pocket with a tenure of around 60%. And throughout the centre of Ulverstone, there looks to be around 20% public housing. And generally, the owner-occupier percentage within Ulverstone was relatively good, up around 70 to 80%. Looking at the town planning risks, there were some inundation overlays following the shoreline and the river, and some bushfire management overlays around the town. Again, property prices within Ulverstone have really just skyrocketed. They're currently sitting around $650,000, which seems really high to me, considering that Burnie had a median 3-bedroom house price of around $450,000. And they're quite geographically close. But again, in 2018, you could pick up a house for around about $300,000, and that's now, $650,000. So it is a bit concerning that we've had such huge price growth. Again, very tight vacancy rates since about 2017, 2018. Currently very close to zero. And coinciding with the tight vacancy rates, rents have just been running up over the same time period. Stock on market is pretty typical and similar to the other locations. And the median days on market, according to realestate.com, is 55 days for the suburb of Ulverstone. And the gross yield in Ulverstone is surprisingly tight at 3.9%. So if you're purchasing the median 3-bedroom house for $635,000 and running that 3.9% gross yield, you're getting a negative cash flow of around $14,500 per annum. So that's a bit painful. Additionally, that affordability ratio is very high at 9.6. So you can see the median household income is sitting around $66,000 and the median house price is up there at $635,000. So these yields are just very unattractive. You could legitimately get better yields in Melbourne at the moment if you were purchasing in like Frankston. So just my thoughts, vacancy rates are incredibly tight for all of these locations. In every location, we've seen a big run up in prices. We've seen a big run up in rents as well. Ulverstone is looking a little bit unaffordable on a median income to median house price ratio at 9.6. Also, the yields were relatively tight, so you're not running the greatest cash flow in the world. I personally wouldn't touch Ulverstone. I think I liked Burnie the most with a yield of 5.2% and a median income to median house price ratio of 6.5. So the median 3-bedroom house there was sitting at $450,000. I would probably just feel more comfortable running that yield and purchasing for $450,000. If you think about it, in Melbourne, constructing a new house is probably pretty close to $400,000 at the moment. In regional Tasmania, there's probably a significant premium on that construction price. So if you're purchasing a 3-bedroom house that's in really good condition within Burnie, you're probably purchasing significantly below replacement cost. So that's also good. Also, the vacancy rate was just incredibly tight. And Devonport looked okay. The vacancy rate was very tight. It's done a lot of growth. Rents are running up. But the yields just weren't great at 4.7%. And the affordability ratio was sort of getting up there at 7.7. I think I'd probably preference regional Victoria for a purchase at the moment over these locations in regional Tasmania. But I think both will do well provided that there's a fair amount of population growth in Australia and construction costs aren't coming down anytime soon. So house prices really need to reach that level where developers can provide new stock. And what I mean by that is they can turn a profit in their developments, which is ultimately where the vast majority of housing supply comes from in the Australian market. This video was a really interesting video to make. I was really surprised with how much growth some of these locations have done and how tight the vacancy rate has been. Check out my channel for more investment property content. And I've also got a free Discord community that you can join. I'm in there ranting and raving constantly. Hop in there, discuss the markets. I've found property Discord communities to be really valuable. So join it, and thanks.